Hi, welcome back to the Whitaker-Myers Wealth Managers Question of the Week video series. I'm John Mark Young, and this week's question is a great one. It comes from Judy in Ohio, and she asks, John Mark, I'm getting ready to sign up for my 401k plan. It looks like they've already defaulted the investment into a mutual fund with a year on the end of it. Is this the right mutual fund investment for my 401k plan? Well, Judy, that mutual fund is actually called a target date fund. A target date fund is a very common default investment option within a 401k plan, meaning if you don't tell them what you want them to invest it into, or you tell them, do it for me, is often the way that it's described at Fidelity or Empower or these big 401k providers. They will do it for you. They will default you into a target date fund. Now, are target date funds terrible? No, no one really could make that argument. But the question becomes, are they the best investment option for them? Or said another way, does Whitaker-Myers like target date funds? Well, of course, any 401k plans we manage, they're a part of it, but are they the thing we pursue for an investor to the extent we have a chance to sit down, get to know them, get to understand their goals, their risk tolerance, their risk capacity, all the things that we should be thinking about and dealing with? Probably not the best idea, in our opinion. Now, we could go through all the stereotypical reasons why that is. I mean, you could look at the things like, well, it's a one size fits all approach. Like target date funds are designed for the average investor, average being air quoted here, and they assume a uniform risk tolerance and a uniform financial situation for everyone with the same retirement timeline. Everybody's going to retire in this fund if it's the 2030 fund around 2030. However, individual circumstances such as your risk appetite for somebody that wants to retire in 2030, and other investments you might have outside of your 401k, you probably do, most people do, your retirement goals, they might differ significantly, making the fund strategy misaligned with some personal needs. In certain situations, there can be higher fees. That's not very common with target date funds, but it can be a situation where the fees are just not what you would necessarily want them to be. Definitely, we would argue against a lack of flexibility. They follow a predefined glide path that gradually shifts from stocks to bonds. Okay, those two main assets that most people invest in, stocks being the thing that have historically returned closer to 10% a year. They've got a lot of volatility. They have a standard deviation of around 15%, which means they're going up and down a lot. Where bonds have returned closer to 4 to 5% a year with a much tighter standard deviation, closer to about a 4% standard deviation. And so as your target retirement date approaches, as you get closer to that 2030 number, if that's the target date fund you're in, then they're going to glide you more into bonds than stocks. And that glide path may not adapt to changing market conditions or personal circumstances or interest rate environments. That's one of the things I'm going to talk to you about here in a brief moment of why they're not my preferred investment for our clients in a retirement plan, and certainly definitely not in your IRA, your Roth IRA, your brokerage account, your bridge account, as Dave Ramsey calls it. Because those potentially lock investors into an allocation that just isn't optimal. There definitely can be some over diversification or redundancy. Oftentimes we see people with their 401k where they hold this mutual fund, that mutual fund, probably because they just looked at the 10-year track record and they just picked it. That was it. That was all they decided. 10-year track record looks really good. It's better than everything else. Well, the one thing the government makes us do, the SEC, they make us say past performance is not indicative of future returns. Why do they make us say that? Well, one of our arguments against that is if you have a really sound investment strategy that's been proven over a long period of time, that probably is something that you want to take into consideration, how well they've done in the past. But the reason they make us say that is because one type of asset class, just because it was the best asset class over the last 10 years, doesn't mean it's going to be the best asset class over the next 10 years. For example, from 2000 to 2010, the best asset class was international stocks. Now, how many of you are raising your hand saying, I want more international in my portfolio today? That would be none of you. None of you asked that. Why? Because it's been the worst asset class. So back in 2005, when international stocks were dominating for the last 5 years and just crushing the S&P 500 and crushing the Russell 2000 small cap stocks the phrase past performance of international stocks is not indicative of future returns, meaning they're not going to do the same thing over the same period of time. But Many times we see people that, again, have picked a fund because of good strategies or good returns, excuse me, in their 401k, and then they go the rest in their target date fund. So you have a little bit of this, and then you have your target date fund, your mutual fund with a year on the end of it. Well, many target date funds invest in a variety of funds, like I'm going to show you here in a minute. And those often include a broad market index there. So if an investor already holds similar funds elsewhere in their portfolio, investing in a target date fund can lead to over diversification and duplication, making it harder to manage the overall asset allocation and risk of a portfolio. And then lastly, our argument against it would be it can misalign you around retirement. So the asset allocation, the way it's spread out, the way that money is spread out inside of that target date fund might become too conservative at the target date when it approaches, when that year 2030 approaches or 2035, whatever you're in. And that might potentially limit your growth for someone who plans to remain invested for many years into retirement. What's your average retirement life cycle? It could be 20, 30 years. So conversely, there can also be target date funds that just remain too aggressive near retirement. And that might expose you to more loss than you need or should have had during a market downturn. So all that to say, they're not our favorite investments, but let's dig into a few whys. Why do we're going to look at a few. We're going to look at the Vanguard ones. The Vanguard ones are actually pretty good. They're highly rated, but even the Vanguard ones, I would make some arguments against right now. Let's look at why. On your screen, you're seeing the Vanguard 2060 fund. The Vanguard 2060 fund, essentially, you're seeing how it's spread out across U.S. stocks, 54.25%. How much is in international stocks? 54.09. Okay, so you add that up, and approximately you're about 90% of your money in stocks. Where's the rest of it? This is 2060. So here we are in 2025. We've got 35 years till this 2060 fund is matured, if you will. And you can see Morningstar rates this as a 4-star fund. So they're saying, hey, this is a pretty good fund if you want to be in it. 90% is in stocks. Where's the rest of it? This is a 2060. So 35 years. So this person is probably in their 20s that's in this fund. And 9% of it, 9.43 is in fixed income and 2% is in cash. That means that over 10% is in safer investments. Now, why is that bad? It's not necessarily bad, but we would argue, why does somebody need safer investments for their 401k? 10% of their money. 10% of their money historically has averaged only 4 to 5%, while stocks have averaged closer to 10. Let's say stocks only do 8 and safer investments only do 4 to 5. You're still losing 3% a year. You add that up over 35 years. That's a lot. Why does somebody need safer investments when they have 35 years till retirement? I asked Christine Benz of Morningstar this very question. I was in a class in Chicago. She came to speak to the class. She is the preeminent writer for Morningstar on retirement planning. I asked her this question. Her answer to me was, that's why you're here, John Mark. Financial advisors probably would prefer their clients have another mix of investments than what you're seeing in the target date fund. So was she saying it's bad? No, I don't think she was saying that. She didn't say that. But she did say you as a financial advisor could give more personalized advice, and that more personalized advice probably going to create value for somebody over time. Let's look at the 2030 fund. Now we're looking at the 2030 fund. Now what you see is 36% of the money, almost 37, is invested in U.S. stocks. 22, almost 23, is invested in international stocks. So again, you've got closer to 60% of your money in stocks, 37% in these safer investments, and 3's in cash. Now, this is somebody that's 2030. Here we are in 2025. We got 5 years till retirement. Is this a proper allocation? We would argue, yes. Yes, it is. So, John Mark, why would you not like the target date fund for the 2030 investor? Because it's the appropriate allocation. You don't disagree with the way they've got U.S. stocks, non-U.S. stocks, safer investments in that portfolio. So what's the problem? Well, now you see what they're actually invested in. How do they come up with those dollars? On your screen, you're seeing that. And what you're seeing is the Vanguard Total Stock Market Index is about 37%. The Vanguard Total Bond Index is about 27%. The Vanguard Total International Stock Index is 23%. And the Vanguard Total International Bond Index is 11.73. That pretty much makes up the entire portfolio. Now what you're seeing on your screen is the 11.73% that is in the total international bond index. Okay, so this is one of the safer investments that it makes up about 11.73%, almost 12% of that mix. This is what the international bond market has done. This is a tenth of the portfolio. And it's effectively done over the last 10 years, nothing after inflation. If you were in it 5 years, you got less than nothing because inflation was so bad. If you were in it the last 3 years, you got really nothing less than nothing because inflation was so bad. Ugh. International bonds, I don't understand the investment. You're lending money to countries in many cases and companies in these other countries. And many of these companies are a pile of mess. And these countries are a mess. Why would you want to lend money to them? You've gotten almost no reward. You have the US dollar strengthening against all these currencies. So it makes it even harder to make money. The yield on this right now, the interest rate on these bonds are only 4%. Well, you can be in the US with much better credit quality, much better companies. The US government, if you wanted to, who has effectively zero risk if you buy a US Treasury, will pay you for the same 4% you could earn in this. This is where we're saying we do not like target date funds. We cannot make the argument for this. Now they might have Vanguard might have a tactical recommendation of they think international bonds are going to do well. We'll see over the next 5 years, but we're willing to bet when interest rates in the US are much higher, you have a strong US dollar and you have much better companies to lend to and much better governments to lend to, a government to lend to in the US, and then I guess municipalities and whatnot. You're going to do much better in a US bond fund for your hedge than an international bond. Why does Vanguard put that in there? I have a cynical reason. I think they probably just need flows into that fund. If you look at the funds and kind of the asset value in each of those weightings, effectively they need to get assets into that fund. They have 1.7 trillion in their total stock market fund. They have a third of a trillion in their total bond market index fund. They have a half a trillion nearly in their international, and in this fund they have a tenth. And so ultimately we would argue, client, a target date fund may not be the best place for you to invest. So that's why you should talk to your advisor, have them analyze your 401k for you, run through the options, break them into their growth and income, aggressive growth, international, and then those safer investment options, because every plan is going to have individual options where you can be a lot more tactical and a lot more consistent with the rest of your portfolio, your Roth IRAs and those sort of things. That is the better way to invest in your 401k. Not that the target dates are bad. We never said bad, did we, throughout this whole video? We just said suboptimal relative to your other options. And that's why you have a financial advisor, is to get the most optimal options for yourself. So thanks so much for watching this week's video. If this week's video was helpful to you, you can do us a favor. You can do us a favor by hitting the like and the subscribe button. You can even go into the comments, make a comment. You can say, John Mark, you talk way too fast. Stop, slow down. You need to talk like a robot or something else. Do whatever you want to do in the comments. We don't care. We will give you a thumbs up and thank you for commenting. And would you do us a favor? You can do us a favor by sharing this video with your friends if you think it was helpful, you would be helpful to them, as well as continue to like and subscribe to all of our videos. Thanks so much. We will look forward to seeing you on next week's video.